Stock market tops tend to be more difficult to forecast in real time than our stock market bottoms. That's because market tops are often slow-moving affairs with a gentle trend change at first. Market bottoms, on the other hand, tend to be more V-shaped and are accompanied by spikes in fear that can be quickly reversed. There are a lot more technical tools to help identify market bottoms than market tops. Of course, the wave principle is our primary method for identifying highs and lows, but when we have technical indicators that are suggesting a high or a low at the same time, it enhances our level of confidence in the forecast. Let's take a look at some of the tools and techniques I've come across to help identify market tops as they happen. I'll use charts from the daily wrap-up video I posted on July 26th, the day of this year's market top. There has been more than a 6% decline from that high so far. The first chart shows a wave interpretation at the time, calling the rally as complete. One tool I keep close tabs on is the CNN Fear and Greed Index. This is a sentiment gauge calculated in real time during market hours. It's a good proxy for the state of trader psychology. After this index showed a reading of 75 in late April, the stock market topped about a week later. As the market made new highs in late July, this indicator made lower highs. That's what we call a bearish divergence and is a strong warning that the uptrend is running out of steam. Another tool is one I've developed called the correlation index. It's a basket of financial instruments that have a high correlation to the S&P. When it fails to confirm a move in the S&P, it's often a sign of an impending trend change. Here's a daily chart of the S&P on top and the correlation index on the bottom. You can see that it didn't move above the highs seen in April. Two components of the correlation index are the junk bond ETF HYG and the 10-year U.S. Treasury note yields. These two charts show bearish divergences that were registered as the S&P made its high for the year. Another simple tool that's widely available is the relative strength index. When it makes lower highs while the market makes new highs, it suggests a weakening underlying trend. I like to use a moving average as a tool, trend following tool, because there can be several bearish divergences before they take hold and yield a reversal. This chart depicts the divergences that unfolded as the market was topping. There's also a moving average I was watching at the time, waiting for a break below it to signal that an important top had formed. And another one of the most useful tools in identifying market tops is the Bollinger Bands, you're looking at it on a daily chart. This is an indicator that's available in most charting software. When the market hits the upper band, it usually means limited upside potential exists and warns that a downside reversal could signal a larger decline to come. All of the foregoing charts are what my subscribers saw at the day of the high this year. I'll be keeping an eye on these indicators going forward in the weeks ahead.